A very warm welcome, everybody, and welcome to our Investor Forum this evening with a focus on bonds, a 101 fundamental introduction to investing in, trading, fixed income. We're going to be talking about the risks as well as the benefits. And because it is fixed income, obviously that means that you receive income on a regular basis. In the old days, they used to, in fact, have paper coupons that you had to cut out into the bank and cash. But what happens if these coupons are not honored? They're electronic these days, but at the end of the day, if the money isn't in the bank, then what do you do in such a situation? Of course, we're also looking for your input during the course of the evening. You can interact with us in two ways. One is to use the Q&A function at the bottom of your Zoom screen. Just to key in your question in at any time. We will do our very best to come to your question as soon as we can. Apologies in advance if we can't take all the questions. Usually the questions are very popular, so we will do our level best to answer them all. The other way that you can interact with us is through Mentimeter. And once again, I have here for you a Menti code. It is appearing on your screen now. And you can also see that we're already asking the first of the polling questions tonight. We've got 3 questions for you in all. So get out your phone or use your PC to go to menti.com. You can once again see the 8-digit code there. 3 polling questions that you can answer, and we will take a look at the answers in your responses in just a few moments. Now, I'd like to invite our panelists to also join us here on screen. They are Benjamin Goh, Head of Research and Investor Education at SIAS. Welcome, Benjamin. Good evening. Nice to have you with us. We also joined by Executive Director at DBS Group Research, Mr. Eugene Liao. Hello,
Good
Eugene.
evening, everyone.
Hi. From Beansprout, an investor education company, we're joined by founder and CEO, Mr. Gerald Wong. Hi, Gerald.
Hi, everyone.
Good to have you on board, along with Mr. Mahesh Rai, who's Director of Dispute Resolution at Drew and Napier, doing the late time in the office for us this evening. Thank you so much, Mahesh, and welcome once again to the show.
Thank you, Mark. Happy to join all of you. Thank you.
Now, clearly, when we have a topic such as bonds on our minds, we can't go past the fact that it is, in a sense, a risky environment at the moment. Clearly, we're in a time when interest rates are rising. Inflation, of course, has been very high. Inflation has started to come off. Interest rates are starting to fall again. That volatility, obviously, also is something that investors need to take into account. Benjamin, give us a snapshot of where we are at the moment on bonds.
Well, I guess the stress in the US banking sector is still undergoing or still is ongoing, although the news feed has moved on to something else, specifically the debt ceiling. But I think, if the debt ceiling issue is not going to be resolved real soon, as in the next few days, the banking sector stress is going to show up again. And then the spotlight is going to be going to come back to bonds, as well as the AT bonds or AT1 bonds of the banks in the US.
Yes, let's get into that straight away. AT1. We're not talking about the number 81. We're talking about AT1. Could you just elaborate on why this is such an important issue at this time?
Sure. So AT1 bonds, additional tier 1 bonds, under Basel III rules, they form part of the, I would say, capital of the bank, right? So every bank needs to hold a certain amount of capital, basically to make sure that the banks can withstand any kind of cash withdrawals by depositors. This is an issue that came to the fore because of the takeover of Credit Suisse by UBS. So in that situation, the AT1 bonds for Credit Suisse, bondholders were wiped out, but the shareholders for Credit Suisse were given some kind of compensation, some nominal sum, because of the acquisition. That's actually turning the whole idea of AT1 bonds on its head. So AT1 bonds are still fixed income. So in the pecking order, they should be paid first compared to common shareholders. But in that particular situation, it was flipped on its head, and that caused a minor, I guess, tremor in the system again.
Flipped on its head, Benjamin. They were nixed. I mean, the whole point of these AT1 bonds was to create stability in the financial system. And then when the UBS takeover came along, all of a sudden they didn't matter anymore. What happened?
Well, I'll go on a limb to say that it was probably a political decision, because having retail investors wiped out, or Credit Suisse is like the POSB, right, of Switzerland. So if retail investors were wiped out, that would cause a huge issue. So it was a token sum to placate the shareholders, and AT1 bonds were basically on the hook because those were basically purchased by high net worth individuals as well as institutional clients. I mean, who really cares about hedge funds, right?
Well, I think Eugene Liao might. Eugene, what's the view from DBS on the AT1 bond issue and the fixed income market in general?
Yeah, I think the whole point about fixed income is we got to go back to the basics, right? Is that where do you find yield that is stable, and ideally you don't even need to think so much about it because it's supposed to be safe. And then all those volatility that Ben mentioned has become ever more pertinent because we have gone through a period of the past 15 years or so post GFC, where interest rates are essentially held at zero, and it is very difficult to find any kind of meaningful nominal returns. And there's this reach for yield. But that really changed over the past 1 year plus when CPI numbers hit levels that we have never seen, well, for the past 40 years. So has the landscape changed, right? Does it mean that bonds, well, not just corporate bonds where you have to take an additional kind of risk, or AT1 where you take another set of risks just to get a certain hurdle rate for selected investors? Could you actually achieve a reasonable rate of return while taking on very, very little risk, say in T-bills, right? Or even fixed deposits, right? Could they be viable? Can they beat inflation? I think these are the kind of questions that are starting to come up in our portfolio allocations.
T-bills are treasury bills. Would you just like to give us the 101 on that?
Right. So treasury bills, it's like the most simple of all products. It is IOU issued by the government, so it's backed, and the ratings would be at the highest level possible for the country or entity. So I think the most commonly quoted one would be USD bills, right? And then it is interesting because we are debating if the creditworthiness of the US is intact, right? And that is supposed to be the ultimate risk-free asset, right? And yet the default risks that are currently being priced by the various metrics around 4 to 5%, so not quite 0%, not quite risk-free. Whereas if you look at Singapore, it should be risk-free. We are AAA rated. And we don't face the same kind of debt ceiling hurdle every few years, right? So,
yes.
So in some way, we are definitely much better run, and we don't face that kind of risk. But we are not as deep. We don't have that kind of depth or the size, right, for the major investors to go in and out.
Yes, 4 to 5% risk on bonds that are supposed to be risk-free. By the way, have they finally figured out this whole debt ceiling nonsense? Have they sat down together, had a cup of tea, and figured it all out now?
I think it's they had many cups of tea, but but as to whether a resolution is going to be found, I think the base case is that it will be found, right? But the meandering path would be a pain to navigate, right? Because that there is very little incentive to get on a quick deal and then we go back to BAU, because whether you're the Republicans or the Democrats, you do want to show that you are representing certain interests within your group. And the way they want to achieve any kind of sustainability in terms of debt between spending cuts and tax hikes, I think the ideology is very, very different, right? So I think it's a bit fragmented right now. As we draw closer to the X date, perhaps over the next 1 to 2 weeks, we will probably get more pressure to get a deal done. But as of now, it still doesn't seem to have the same kind of urgency.
Yes, it's only the world economy that's at play. That's okay, ladies and gentlemen of the House of Congress, just take your time. By the way, the X date is the 1st of July. Gerald Wong, when you talk to retail investors as you do, what's your sense of how much they're already familiar with the issues that we've been talking about, and how much do they actually need to know about all the ins and outs of AT1 bills and debt ceiling?
Okay, so in terms of our interaction with retail investors, I would say that the level of understanding towards bonds would probably not be as high as some of the other financial products, such as equities. So I guess in terms of analyzing stocks, maybe even REITs, Singaporean investors seem to have some degree of familiarity and know what to look out for when investing in stocks and REITs. But when it comes to bonds, what we see is that there is probably a need to understand how do we think about the risk, what is the order of the different bonds that could potentially come in. So that is something that I guess is why we are here tonight, to have this discussion and also to understand what are some of the questions that participants might have. So just to cite a very small example, I guess most would actually think of stocks as something that is fairly straightforward. If the company's performance from an earnings perspective is going well, then the share price would actually go up. But for bonds, I think just a very simple concept around the interest rate risk. Some may actually not be familiar with the fact that when interest rates go up, the price of the bond actually goes down. So even this interest rate risk is something that we feel is important to highlight to investors, because often we come across this discussion around whether would the T-bills be 100% risk-free. So even though it is backed by the government, there is still a certain degree of risk relating to it, especially if investors were to sell the bond before the maturity. And in this case, if the price of if the interest rate has really gone up, then there's a risk that the price of the bond has fallen, and there could be a risk of capital loss as a result. So I think that is something that we continuously highlight. And there are also other risks relating to bond investing that we feel would be important for investors to know as well.
Yes, isn't that one of the other fundamental but often misunderstood aspects of bonds, right? That when the price goes up, why does the yield go down, and vice versa, Gerald?
Yeah, so I think that is something that investors may not understand as much compared to, say, the idea of investing in a stock where when your earnings actually go up, if the valuation of the stock is to be looked at in the same way, then the price of the stock would actually go up. But I guess when it comes to bond investing, it is actually somewhat of an inverse relationship, in that when the interest rates actually go up, the price of the bond actually comes down. That is because of the fact that when you have this coupon payments that are being made to investors, what we are actually doing is to discount the value of these coupons backwards to how much you are actually receiving over the future years. So I guess when the interest rates are actually higher, what this means is that the value of the bond that you're holding on to would actually be worth less.
One of the questions that we've asked you this evening is, are you invested in bonds right now? Or what are actually your preferred asset classes? This is how you have voted so far. And incidentally, if you are yet to add your voice, you can do so by scanning the QR code here on the screen. You can also see that there is a Menti code that you can go to on your browser. key in menti.com and the eight-digit code here. And you can also go to the chat where the link to the voting page is also appearing. And what we're seeing here is that out of the 17 of you who have voted so far, stocks and REITs are ahead, with bonds coming up the rear. Mahesh, in a sense, you're the odd one out tonight. We've got 3 financial services expert. What's a lawyer like you doing in a bond discussion like this? What sort of contact do you actually have with bonds, and what do investors need to know about the legalities of them?
Sure. So I've been invited to speak because the Credit Suisse additional Tier 1 bonds are all the rage at the moment. And a lot of the bondholders are up in arms because these AT1 bonds, as you call them, they've been written down. And as of the current status is that the bondholders will actually receive nothing. So lawyers are in the spotlight at the moment because they are taking all kinds of action against FINMA, which is the Swiss regulator, and they're also contemplating action against the Swiss government. So I am currently representing a group of bondholders, one of whom is one group is trying to set aside the Swiss regulators' write-down order. The other group is bringing an investment treaty claim against the Swiss government for the losses on the bonds. So what are the legalities that people should be aware of? I think one of the most important things to be aware of would be the terms of your bond instrument that you're actually holding on to. You'd be surprised, even though the requirement is that accredited investors should be the only ones who actually invest in additional Tier 1 bonds. Many of them have not actually read the terms and conditions until the Swiss regulator decided to issue the write-down notice. So I think it's important to actually look at the terms and conditions and what would cause the bond issuer to fail to pay out. What would be the trigger events? What is a liquidity event, a viability event, an insolvency event that actually would trigger certain defaults on the part of the bond issuer, and such that you won't recover your principal, you won't recover any interest or coupon payment. So this is again where, looking at the terms and conditions will actually give you a clue in as to when would it be that there will be an event of default. Some bond instruments actually provide if the net borrowings to total equity exceeds a certain threshold, that in itself is an event of default. So I think investors should be a bit more careful, right? Not just choosing a reputable issuer, but you should also be alive to the fact that if there is the onset or there are certain sightings of events that may lead to an event of default, you may then choose to take certain protective actions on your part.
Yes, and you just said the terms and conditions of the bond. I guess, when you're buying a stock, you tend not to think of it in those terms, right? You just log into your internet banking platform, you place a trade, no terms and conditions seemingly leap out at you. How is this different with bonds? I mean, what sort of range of terms and conditions should you be aware of?
So the bond documents will normally provide for when the issuer will actually have the right to refuse payouts, right? So events of default, for instance, any kind of judicial management, restructuring, insolvency on the part of the bond issuer. So it will actually give you various scenarios in which the bondholder will be refused payment, or the principal value of the bond will actually be written off. And the terms of the bonds would actually provide for rights that you have as a bondholder, right, in the event of a default. So it's different because, as someone said during this seminar, it's reduced to its core. It's essentially an IOU. The terms and conditions really are the nuts and bolts of how that IOU actually functions. It's a loan contract at the end of the day. And if you don't read the terms and conditions, then you are simply investing in what you consider to be safe investments, but blindly, in truth.
Now, bond investments usually come in fairly large ticket items. Is it too much to assume that everybody reads the terms and conditions? I mean, we all know what it's like when we buy software. We just click accept without actually reading the terms, right?
I think this is where bonds, I think, are in a separate category. You see, unlike equity investments, right, which can range from a couple of $100 to a couple of thousand or millions of dollars. Take the Credit Suisse additional tier 1 bonds, for instance. Depending on which tranche you purchased, it would be 200,000 to 250,000 US dollars or Singapore dollars. Many accredited investors invested multifolds of those values, right? So 1 million, $2 million. When you're putting so much of your retirement money or so much of your spare cash, as you will, into one product, I think the obligation on you to actually be alive to when that form of safe investment, so to speak, would stop paying out, then becomes a lot more heightened. It's not simply a Windows software, not simply a Shopee purchase. It's $250,000. It's a large amount that you're actually investing in. So I think it requires, or rather it calls for greater diligence on the part of the investor.
And one final point on the AT1 bonds, I guess the reason you're involved is because all the bondholders who got virtually nothing back on the AT1 bonds would have invested in them precisely because they are senior, right? Precisely because they were deemed to be much safer. Presumably, therefore, you think you have a pretty good case.
Yes, so I think this is not the situation like Hyflux, for instance, where there were certain poor decisions that were made on the part of Hyflux to go into the power generation business. And that led to, the non-financial viability of Hyflux as a company. And so they simply stopped paying out. In this situation, what happened was there were what we call extraneous events, right? So the Swiss government, in order to prevent a run on the bank, then decided to take the extraordinary step to write down these AT1 bond instruments. And I think Benjamin said it rightly, because it is effectively turning the whole regime on its head, right? Because you expect the shareholders to be the first ones to absorb such losses, but instead you're going after the additional tier 1 bondholders. So that actually does not bode well, because it doesn't follow the usual ranking scheme in an insolvency situation. And you can tell that that's the case, because in the aftermath of the write-down, the EU, which is the European Central Bank, the Bank of England, Monetary Authority of Singapore, all of these regulators came out swinging, and they said, unlike what's happened in Switzerland, we respect the traditional hierarchy of losses. And if in the event that there's a similar event that happens to one of our entities, one of the institutions in our country, then the additional tier 1 bondholders will not be the first ones to be sacrificed, right, at the altar of, I suppose, politics, I suppose, sweetening the deal for UBS, whatever you want to call it. But the fact that these regulators deemed it fit to come out and clarify that in their countries this wouldn't happen, it tells you that, at least from our perspective, we've got a pretty strong case.
Good. Well, meantime, let's take a look at your questions. And once again, please keep them coming. You can do so through the Mentimeter code or here on Zoom. Now, here's the first one. And James, you're asking a very good question about the difference between secured senior and junior bonds. Particularly, what are the characteristics that distinguish senior and junior bonds? Let's have Benjamin, followed by Gerald.
Yeah, so as the name suggests, so senior bondholders will be paid out first. So there's the pecking order in terms of payouts, as well as if there's a default event. So generally, senior bondholders will bear less risk, but correspondingly, there's no free lunch. So less risk means lower returns, lower yields. And if you have got subordinate bondholders or junior bondholders, then it's more risk, because they'll be paid after the senior bondholders, but again ahead of common shareholders, and therefore they get a little bit higher yield. Then obviously you've got the whole companies in default, like for example, maybe Hyflux as a bad example. And then that is the whole structure is basically a junk bond structure, right? So obviously you're going to get super yields, but it could already be in close to default. So generally, investors can pick and choose. You want higher returns, higher risk, or lower risk, lower returns. It's like a Shopee, a supermarket out there. Let's pick what you want.
Thanks, Ben. Gerald.
Yeah, so I think if we were to try to understand whether to invest in a senior or whether to invest in a junior bond, I think one of the key things that we can look at is what is it secured against. So this would usually be against some form of collateral. It could be some form of a plant that the company has. It could be some form of working capital. So there are the different things that this debt can potentially be collateralized against. I think if you were to want to do some analysis around it, it will be really whether we think that if there were to be any financial difficulties, whether this collateral that has been issued can actually be something that the holders of the debt will be able to make a claim against. So to be able to once again go back to Ben's point about understanding what are the risk reward of investing in different classes of the bond, that is something that we can look at to help us understand whether we should be looking at the secure part or whether we want to be getting a high return, but then maybe not having any collateral against it.
Okay, now, once again, if you'd like to take part in the polls, this is how you've voted so far on what your preferred asset class is. And clearly, while stocks continue to be the preferred asset class, bonds are not far behind. And we'll talk about why REITs have been broken out as a separate asset class shortly. But we also asked you this question: have you previously lost money due to a bond default? And about 4 in 5 of you say yes. Now, Betty, you just messaged in the Q&A that you bought bonds, but your relationship manager didn't read to you the terms of the bonds in the event the company went bust. And YL, you've added that if you are an accredited investor, will you deem to be able to cope with more risk, unlike the mere mortals, the common retail investors? And if things happen, are accredited investors unable to sue their relationship manager or financial advisor that sold you the product? Let's see if we can get your wraparound response. First Eugene, then Mahesh.
Yeah, I think might be more appropriate for Mahesh to take these questions rather than me. So maybe Mahesh, can you take it instead?
Yeah, sure. I think that generally speaking, as a general answer, it is no excuse on the part of the bondholder to say that the RM or the private banker or the private wealth manager who was selling me these bonds did not explain to me the terms and conditions. We all know how these things work, right? You meet the individual who is your banker and he goes through the highlights of the bonds, right? Mostly he deals with how reliable the bond issuer is, what are the circumstances of payout, what are the past payouts, what are the past defaults, if there are any, and certain risk factors. But most of the T's and C's, they actually leave you to actually go and read them by yourself. So if it was given to you and you chose to sign on the dotted line without reading the terms and conditions, then I don't think a case can be made out against your private banker or private wealth manager. So that's the general answer that applies throughout. Now, there is a caveat to that. Obviously, there are cases of mis-selling. What is a case of mis-selling? If the person selling you the bond, for instance, makes a statement which is obviously untrue about the bonds. So, for example, they may say that it's 100% guarantee, there will be no default, this institution will survive the test of time. I'm giving an example in the extreme of this. So those forms of statements are what we call representations, and if those persuaded or induced you to sign up for the bonds, then arguably a case for mis-selling can be made out. But those are few and far between. Now, obviously, because accredited investors are a special class, you must have had an income of more than $300,000 in the past year, or if not, I think net total assets of $1 million or $2 million. If I'm wrong, the financial people on this call will actually correct me. But one of those three, right? I think that the reason why MAS has put out that status is because you are presumed to know better, or at least be able to find out a bit more, even if you didn't know, rather than a man on the street. So Again, there's greater agency on the part of accredited investors, and it's on the onus is on the investor to actually read the terms and conditions. It's a bit like signing up for your mobile phone line, where they say, look, it's a 24-month contract, and then when you try to cancel early, and then they try to charge you an early termination fee. It's no defense to say that the person who sold me the mobile phone did not read out that particular condition to me. It applies even more so with bonds.
Okay, so even whether you're an accredited investor or not, like Betty, doesn't make any difference. In other words, you've got to read the T's and C's. Yes. Okay. However, there are two other points here, and I'm glad you've raised this. I think it's Mr. Yup and Mr. Ko. Thank you for your contributions here in the Q&A on Zoom. You're writing, the terms of a bond are in hundreds of pages, shrouded in legal terms. Mahesh, that's you. If there is a need to fully understand the terms, is it possible, it is impossible to invest in bonds? Is there not a simpler way to assess bonds to invest?
The answer is yes. So I'm going to use the Credit Suisse example again. There is usually a highlights page, which provides you with the main terms and conditions that you should be aware of. There is also, depending on what you're buying, right? I think the bankers on this call will be able to elaborate better. On top of the highlights document, which is usually a 5 to 10 page, it's like a hit list of the most important things that you need to know about the bond document, about the bond T&Cs. They also probably have slide decks which will set out certain terms over there. Those are the key terms that you should be aware of. I think it's very important to pay attention to the circumstances surrounding default and non-payment of coupon payments or interest payments, or any provision relating to a loss of your capital. If you read up on those particular provisions, at the very least, I think you will be protected. I think that would be my answer to that.
All right, Eugene, he just kicked it back to you, the bankers. Come on.
I think in the end, when we are looking at looking after our own money, right, that there should be a certain sense of responsibility. So usually putting one of the red flags would be if is there anything as a free lunch, right? So if something sounds too good to be true, or if it is sounds too good to be true, then I think there's a need to be wary. Right? High yields usually mean higher risk. And I guess the question is, does it make sense in the context of your total portfolio? Well, I think, well, it is, a lot of it is a personal decision and not so much when you're dealing with large sums. It shouldn't be a rash kind of a choice. So even when you deal with very, very safe stuff such as T-bills, so for example, if you buy Singapore T-bills, your money is locked in, right? It's not like you could easily get out of your 6-month T-bills very easily without any kind of liquidity losses, right? So it's not like an FD where you can break it and basically there isn't much penalty to it, right? So I think any kind of investment, even if it is as little risk as possible, there are some. It's just a matter of risk tolerance and how that fits into your overall lifestyle and your overall portfolio. And so these have to be considered.
Yes, along with your investment objectives. Now, Benjamin, when earlier on Mahesh said that there was, you can't just sue your financial advisor because you claim to not have read the terms and conditions. What about going to SIAS? Can you actually do anything about it?
Well, I guess taking example from the past, so we did push back on some of the issues surrounding Hyflux as well as Bostad. The challenge for SIAS is that we want to make sure that it's a good outcome for both the company as well as shareholders, bondholders, so on and so forth. So it's not just shareholders' interest that we seek to provide, but it's basically the entire ecosystem. That said, it is, I do believe that it is, everybody's individual responsibility to read the T's and C's. But again, I do accept that the terms and conditions are actually very wordy. I myself don't really like to read the prospectus of stock IPOs because it's like 100 pages. I mean, I've got better things to do with my time, like Netflix. But the thing is, then I stick to simple investments, right? So bonds, well, I mean, I can just go for the Singapore government or Singapore savings bonds, and pretty straightforward. Equities, well, if you don't like specs, there's always Singtel or DBS, pretty straightforward, right? And they don't, they're not like subpar performance. I mean, they may give you less yield, but it's not dramatically less. So you lower your risk level quite a fair bit for giving up a little bit of yield. I think that's a good trade-off, and then I can get on with my life. So a lot of times we say that it's difficult to understand things, but we can always structure our investments in a certain way that fits our own lifestyle choice. I think that's something that everybody can attain. It's just not that difficult, I think.
Yes. Okay. Well, have fun on Netflix. By the way, you're talking about SPACs in another SIAS seminar soon, are you not? Special purpose vehicles. When is that again?
Yes, as well as SDRs. Pretty soon. We do that kind of talk every month or so. Yeah.
Yeah. Okay. Let me kick it out to Gerald too, because this thing about the legal terms being too legalistic. Now, Gerald, as Mahesh says, you can always read the PowerPoint slide, but often the impression there is that actually the PowerPoint deck is just a bit of marketing. What's your take on, is there a little like a middle ground between the legalistic terms and the marketing document?
Yeah, so I think as what Ben shared, we need to make our research revolving around our lifestyle as much as possible. So apart from the few different resources that have been shared, one or two other useful resources that might be helpful. If you find the T and C is difficult to understand, I guess number one would be professional investment research put out by the different brokerages. So there are different issuances that would have been covered by the brokerages. And if we can get access to some of these reports, then it might be helpful to get an understanding about how the analysts thinks about the credit rating, thinks about the liquidity of the company, and whether it might be worthwhile investing in the bond. I guess with the proliferation of digital technology, different platforms, we also have got different content sites that have come up. So for ourselves, Beansprout as an example, we also provide educational content on some of the bond issuances. They are not meant to be financial advice, but in terms of understanding some of the salient points around the different issuances, hopefully they will provide some form of guidance, even if they may not be taken to be financial advice.
All right. And Eugene, what do you prefer, Netflix or reading a prospectus? I'm sure you're going to choose the latter. But is it easy for somebody at your level to understand these legalistic documents?
I guess the issue is how much time does one have, and whether are we in the correct profession, right? So for example, if you're in finance, then the finance jargon is easier for us in the industry to follow. And then, but if we go to a doctor, we have no idea what they're saying most of the time, right? It's the same if you go to a car mechanic and they tell you, hey, that thing is an issue. We also have no idea, right? So there's always a little bit of information asymmetry there. And I guess the question is, if we are investing seriously and we are not gambling, then there's a need to do some homework, right? So anybody can be an investor, right? We don't have to be in finance to be an investor. But if that is not your line of work, then you should put in some effort to try and understand the risks.
Okay, and that brings us to this next question. One of the poll questions that we asked you this evening, and once again, you're still welcome to vote, is how useful credit ratings are. So this is where companies like Standard & Poor's, Moody's, Fitch, and others actually read the prospectus and make other various judgments to issue a rating. In view of the financial crisis 13 years ago, there was a lot of soul searching because even some of those instruments that went bust had very high ratings. So we asked you, how useful do you see credit ratings, which springboards into our next question from Mr. Koh. Mr. Koh, thank you. You're asking, can you direct non-institutional investors to platforms or services that give reasonably thorough credit default risk probability, at least for those that are traded and issued in the Singapore market? Any recommendations, Eugene?
Oh, I look mostly at the sovereign space. So when it goes into corporates and those listings in Singapore, I'm probably not the right person. Maybe Ben or Gerald would be better.
Okay, I'll take a stab at it. Okay, so if you're talking about retail investors, there's two parts to the fixed income market. So you've got the institutional bond market, and then you've got the retail bond markets, right? So institutional bond markets are the kind of bonds which Mahesh works on. It's a quarter or rather $250,000 per pot, right? You want to buy one lot, it's 250K Sing. Retail bonds, you can just talk to your broker or use the platform as, I don't know, $1,000 per lot. Now, the challenge is, of course, as a retail investor, you normally don't have access to institutional bonds unless you're willing to pay $250,000. But the retail bond market is pretty straightforward. So you've got, like LTA bonds, HDB, that kind of stuff. It's very low risk, government link bond market. And, although the yields are not great, but if you want something to at least, I guess, tolerate inflation, that could be part of your portfolio. So I think that's the challenge for retail bond investors. You don't actually have got access to the diversity of products out there, and hence that might lead you to getting a subpar portfolio.
All right, let's thank you for those for that input. Now, Mahesh, Betty is back. Thank you, Betty. You're elaborating very candidly on what happened in your case. You're writing, my relationship manager gave me a rating from Bloomberg that the company was grade 1. So it's unlikely to bust. Presumably that's what your relationship manager told you. Really, he didn't give me the bond T's and C's to read. Mahesh, is this actionable in any way?
I think if the rating that was given by the banker was wrong, in other words, it failed to reflect what the actual rating was, then there is some basis to say there is some misstatement by the banker. For the bond T's and C's, I mean, it's a question of whether there was any obligation on the part of the person purchasing to ask for them, right? That I think, unfortunately, I mean, a good argument can really be made out that the bankers should really have provided the T's and C's, but also since we're dealing with investors who are dealing with, risky, high value type products, I think there's, as Eugene says, we have to take responsibility for our financial investments. So I wouldn't be the one who wants to test this out, but obviously people who have lost money, and there have been situations where the duties of care on the part of the banks who are selling these instruments have actually come under the spotlight, right? So one of the usual duty of care is basically a negligence standard, right? Not to be negligent as to the truth of the statements that you're making. Of course, fraud falls on the other end of it, which is if you're just simply making up statements recklessly and not concerned as to the truth of them, then that's a very obvious case, right? Where you can actually then claim against the bank or the banker for mis-selling. But a lot of people actually have buyer's regret, right? Because they failed to actually understand what it was that they're putting their money into. And then when the event happens, then they start crying foul, and that's when they're looking for somebody to hold the baby when the music stops.
Okay. And Benjamin, a grade 1 on Bloomberg. I didn't know that Bloomberg even did ratings like this. But then again, some of the rating agency type ratings also don't seem to be all that popular, right? I mean, as we saw from our poll here this evening, there seems to be a lot of skepticism about the ratings agencies too.
I think part of their skepticism is because of Hollywood. Remember the couple of movies that came out after the Great Financial Crisis, like The Big Short. It's on Netflix, by the way. Fantastic show, right? So in one scene, the hedge fund manager actually went to, I think it was S&P, and asked the lady why she gave a triple A rating to a subprime mortgage that was essentially worthless, and she kind of alluded to that it's because of commercial reasons. Because if S&P didn't give them a triple A, then Moody's would, so on and so forth. So that's part of that, yes. But the other thing that I want to point out is that different providers, like Bloomberg for once, S&P, Moody's, they have got different models. Generally, they're directionally the same, so they come out with the same output. But coming back to Bloomberg, so I'm looking at Bloomberg. So Bloomberg does have a rating. It's called investment grade. So if IG1, there's actually less than a 0.5% chance of default. So it'd be very strange if the FM or the RM gave her proposed a bond that was IG1 graded and it actually went bust. That's very rare. It's probably as rare as winning the weekly toto.
Yes. Okay. Thank you for that. Now, Mr. Chi, you're asking, is there a cooling off period on the purchase if the investor regrets his investment in bonds? Benjamin.
Oh, okay. I thought we were looking in general. So whether there's any recourse, was it?
No, so it's like when you buy an insurance policy, isn't there a cooling off period? Does the same thing apply to buying bonds?
Actually, I don't think so, because if you put a trade through your broker, if it's done, it's done. So they will give you the all-in price, including the accrued interest, and then you pay up. I don't think there is a free look period or that kind of sort. It's just that it is over the counter, but it's the same as entering any kind of investment.
Okay. Gerald, any additional thoughts on that?
Yeah, so I think Ben is probably right. I think because of the nature of the financial markets, there wouldn't be a cooling off period in most cases. So that is something that investors need to be aware of and to be able to make an informed decision before they actually execute on the trade or to put in the buy order.
Okay. Eugene Hero.
Sorry, actually,
Ben.
that's it, right? If you're talking about insurance, there's a cooling off period, right? So I'm just
Insurance
wondering whether investment-linked policies, which is basically protection plus investment put together, perhaps there is a cooling off period. I don't know.
Okay. But it seems that if you're doing the trade on the market, that's it, right? Just like with a stock, there's no cooling off period. Eugene, a couple of questions here for you. Thank you once again. I think it is Mr. Yup. Apologies if you are a Mrs. I try to invest in bonds where issuers are owned by Temasek or the local banks. Are there any flaws in this thought? Now, I realize, Eugene, you can't give investment advice, but because, you say that you're covering the sovereigns, would you consider Temasek to be like a sovereign?
I think so. So I guess in terms of the risk profiles, it should be very, very similar, right? So I don't know how else to think about it. If you look at the curves and the yields that they have, I think it is usually they compare it to what the Singapore government have issued. So I think, well, yes, many people view them to be fairly similar, if not exactly the same.
Yeah. Okay. And Mr. Tan asks, defaults in Singapore are not common as far as I know. Thank you, Mr. Tan, for your question. He's asking, what have been the defaults so far?
I don't have an answer for that. I have to look it up because this would be in the credit space, and it's again be beyond the area which I look at. So
right, because you look at sovereigns, right? Yes. I think you said that is government issuers. Okay, Mahesh, let me kick this one out to you then. Especially because obviously, as you are surveying the field, do you have that question on or an answer to that? How many defaults have there actually been, and do you have any views whether investors should treat Temasek linked company bonds differently from sovereign?
I think to mine, some people will consider the Hyflux incident to be a default, although the question as to whether that would be preference shares default or would there be bondholder default there. There was also the issue with Chris Energy, but memory doesn't serve as to whether that was a bond default or not. So these are some recent cases where there have been some defaults. Now, as to whether Temasek linked companies are considered to be safer or not, I think you always have to do your due diligence regardless of who is the big shareholder. Because let's not forget, Temasek also invested in FTX, right? And that's also a Temasek linked company, arguably. Let's not forget the SEC gave Bernie Madoff a free pass on 3 occasions, despite there being whistleblowers. So at the end of the day, the people sitting behind the SEC, the rating agencies, Temasek's investment board, they're just human beings, right? They are also fallible. And at the end of the day, they can also make mistakes. And you'd be surprised, sometimes accredited investors who are not bankers, who are not traders, who are not hedge fund managers, sometimes they do spot certain signs which a lot of people in the trade have not actually spotted. So I was recently contacted by a client who was actually who FTX had actually pitched to, but he looked at the entire model and said it doesn't make any sense to him. Money was coming or going, or it just seemed too risky. So he made the right judgment call not to put his funds money into FTX, whereas Temasek made the wrong call, evidently. So it's not a question of whether Temasek is backing that company or not. It's a question of the fundamentals of that company. And really, you should be investigating that rather than who the shareholder is.
Okay, here's another one for you, Mahesh. This one is from, I think it's Mr. Makaria. Hello. You're asking, how do I ensure my rights are protected if I invest in a bond ETF, such as the ABF Ban Asia Bond Index Fund? And Mahesh, I guess we could also take unit trusts that invest in bonds into the same breath, can't we? Because we're then not reading the prospectus for every individual holding in that bond fund. We're relying on somebody else to do that. What are your rights as a unit holder then?
So index funds, and again, I think the others on this call will correct me if I'm wrong. I think they are slightly different because they invest in a variety of sources to begin with. So they tend not to put all their money behind one company. It's a bit like you're having ETFs, right? Exchange traded funds. So the key question there is the diversification, and the diversification really ensures that the unit trust keeps on paying out on a regular basis. Now, of course, you also have unit trusts where the ebbs and flows when it comes to the principal value as well. If you look at, for instance, Great Eastern Life, right? They've got some Asia Growth Fund, right? It works like it's essentially a unit trust as well. The principal value, the underlying value of each of the unit trusts alters over time. So there again, you should probably ask the person who's selling it to you to explain what kind of markets that unit trust is going to invest in, and how does it protect itself from the exigencies of the financial market. So I think it's not really with ETFs and unit trusts. The analysis is slightly different. It's not so much on the individual company. It's about how do you make sure that your boat stays afloat no matter what happens in the financial storms.
Okay, Benjamin, and then Gerald, any additional thoughts on index funds?
Completely agree with Mahesh that it's really about the market risk. The built-in diversification is great. I love ETFs. I think it's the best thing since the invention of sliced bread, simply because you have a whole unit trust fund which is listed on the stock market. So apart from the regular protections that you get as an investor, it's also regulated by the regulator as well as the exchange rules, right? So it's very hard for something terribly wrong, something to go terribly wrong. And it's a pretty straightforward product. So ETFs basically for an index. So it's ABF, Asian Bond Fund, S&P 500 STI. If you think that Singapore is going to go up, just buy the STI ETF. It's very straightforward. Yeah.
So agree around the fact of how ETFs offer diversification for investors who do not want to read individual T&Cs, but want to get broad-based exposure to a certain asset class. Then the ETF does offer the advantage of being able to spread out some of the risk. But still, it is an investment product. So while the diversification does help to spread out the risk, it is still important for us to do our due diligence around the different ETFs. So using bond ETFs as an example, while they do spread out the investment across different bonds, we have seen still some concentration risk for selected ETFs, where their top 5 bond holdings might already make up close to 60% of the entire ETF. So what this means is that if one of them were to go bust, there might still be a potential capital loss of close to 10%. You don't get all your money being wiped out, but still it may come with a capital loss, which is why it is important to still read the terms of the ETF to understand what is the underlying of the ETF. The other thing would then be around your expense ratio of the ETF, because that is something that can potentially eat into the long-term returns of your investment. So while we think about how the ETF is able to offer us diversification, we should also think about the cost that comes through from investing in different products.
Okay, now we are about 20 minutes away from call for final questions. So please get your questions in. We will do our best to answer as many of them as we can. And there still seem to be quite a lot of questions this evening about research, about where to get the information from. Mr. Tan, you're saying that many research reports are not available for bonds. And even if they are, they may not be available at the point of bond purchase, especially during new bond issuances. You go on to say that pertaining to credit ratings, many Singapore dollar bonds may not even be rated. So what information can investors rely on? Let's have Benjamin, Gerald, and then Eugene.
Okay, so I think it is really because of the way the retail bond market is structured. To be honest, there's very little money in it to write research for retail bonds. If you're going to be paying $250,000 for institutional bonds, yeah, okay, so the bankers are going to make some money by writing research reports. But if you're going to be paying $1,000, okay, so that's the commercial reality of it. Now, that said, as a proxy, you can always look at the financial viability, the performance of the company itself. So if company XYZ is issuing a bond and there's not rated, then look at the company itself. Are they profitable? What's the cash flow, interest rate, interest coverage ratio, so on and so forth. So the usual measures that you use to decide whether or not the company is good or badly managed, those can be used as a proxy, but not great, but at least you can have some comfort level that cash flow is sufficiently strong.
Okay, so I guess Ben has mentioned this part around doing your own due diligence, which we believe is important for all investors. But if you feel that you require additional guidance, especially relating to issuances that might be a bit more complex, I guess there are 2 suggestions. One, I've seen some content issued by Bond Supermart. So that is one of the platforms that I do go to. This is not an ad. I am not paid by them in any way. So I do see that there is some content relating to fixed income issuances. On Beansprout as well, we do try to offer some kind of content, especially if it is something that a lot of retail investors do ask for. So looking back at some of the past retail bond issuances, I think there was one by Fraser's Property in September last year. So given that there were quite a lot of people asking for that, we did do a write-up on Fraser's Property Green Note. So that is not meant to be financial advice in any way. So it doesn't give a recommendation. It is not a credit rating. But in terms of some of the key things that we can keep a lookout for, the balance sheet, the liquidity ratios, those are some of the things that we do provide in a factual as well as informative way.
Now, Eugene, maybe I can tweak the question a little bit over for you as to where the research, where people can get the research, where they can get the information. YT suggests that banks have treasury specialists that retail investors rely on for bond recommendations. Hence, shouldn't the banks use their expertise to weed out bonds that are deemed too risky for retail investors to buy in the first place? So maybe you can wrap up both of those questions at the same time.
Yeah, I guess the issue here is one of risk to reward, right? So that there is a price for a certain level risk, right? So if it is riskier, you would expect higher returns if it works out, but there'll be a reasonable chance that the entire investment goes kaput, right? So then the issue here is whether where on the risk spectrum are you, and does whoever who is helping you out with your investment choices understand it, right? So I think that therein lies the issue. And then the one other point is that there are regulations around distribution of credit research, right? And it seems to be, from my understanding, stricter than equity research distribution, right? You can find them pretty easily for Singapore stocks. But yeah, for credit, it's really tough. And even for us, we have to be very careful who we send to, right? You might have to be accredited investor. You might have to be with a client and then through some investment counselor or somebody who is helping you out. You can't access credit research that easily. I think that is the harsh reality, and you might have to comb through the results every quarter on your own, right? I think that would be the sure way to get the latest figures. Maybe some other comments relating to earlier questions, which just to add to what the others have said. I think whenever people look at ratings, we should understand that it is a snapshot, right, of a series of numbers and conditions that are in place when that rating was made, right? And some of these numbers could be 1, 2, 3 months old, right? And then if a shock hits, then that rating will be outdated, right? So and there's no way to predict the shocks that could be hitting at any point in T plus 1, 2, or 3. Right? So I guess we just got to understand the limitations and that things change, and in the more recent past, things change very quickly.
Right. You need to keep tabs just like you would your stocks portfolio, I suppose. Let's get on to the subject of defaults, because quite a number of your questions have come in on that this evening. Mahesh, let's kick it off with Mr. Leong's question. Hello, good evening. Thank you for asking this one, Mr. Leong. You're asking, in general, Mahesh, what are the remedies available to bondholders should the underlying company?
Yes, so I think it depends on the bond terms and conditions. So one of the remedies would be suing the bond issuer. So the key question there is, do the terms and conditions provide for a direct action between the issuer and the bondholder? And the answer to that depends on what the T's and C's on the note or the trust deed actually say, and the certificate. So the registered bondholder is usually the bond or the note trustee, but note certificates will also provide for direct rights against the issuer once there is a default. Now, there are also some practical issues with instructing a bond or note trustee, because you need to indemnify them to the trustee's satisfaction. There's some quorums or voting thresholds, and it's a question of timing as well. You need to engage with other creditors, debtors, in order to corral together enough support. So if there's no bond or note trustee, then the bondholders usually act through an informal steering committee. So that is very much like a liquidation proceedings where you have a committee of creditors. Then you should also query the situation. What happens if there's insolvency, right? If there's an insolvency event. So you can only sue the bond issuer if the bond issuer is still a going concern. But if the bond issuer becomes insolvent, then the key question is what happens to those bonds. So there are different scenarios for liquidation, for judicial management, for schemes of arrangement. The latter two, really, you're bringing in an insolvency professional to try to restructure the company and try to turn it around, right? That's effectively what happened with Hyflux. That's effectively what happened with Swiber. That's what's happening with, I believe, what's the nickel trading company, Envy, right now. So they put them in these schemes and do not just liquidate them outright. Now, depending on what particular scheme it is under, the bond document will normally provide for certain types of rights. And in some situations, the reason why right now the Credit Suisse situation, everyone is going for the Swiss regulator or the Swiss state, is because the terms and conditions actually provide that it was the viability event that was determined by the Swiss regulator. So that's who you go after. And also, you should also be alive to the jurisdiction clause in the bond document. So, for example, let's take the SIAS 81 bonds again. A lot of people were very surprised, despite the bonds being sold in Singapore, that the bond documents provide that if you wanted to sue Credit Suisse, you have to commence an action in Swiss courts, and Swiss law governs the dispute. So that was also something that came as a surprise to some people, because they were asking how were they allowed to sell those bonds in Singapore when it's effectively a Swiss dispute resolution clause. So those are some of the things that you should be alive to: jurisdiction, the events of default, what happens in insolvency scenarios.
Wow. So when Violet asks, is there any chance for retail investors to get part of their money back in some of these cases you've mentioned? Wow, it really sounds like you're swimming against the tide if you have to corral the other investors. She asks, what is the best way to go about it? Litigation? Who should they sue? Thanks, Violet. Mahesh.
Yeah, so let's take the example of in other countries. So after the Argentinian financial crisis, the sovereign bonds were actually written off. And you had a couple of thousands of these bondholders who banded together and started an investment treaty arbitration against the Argentinian state. They got to phase 2 of that dispute, and the Argentinian state actually paid out 50 cents to the dollar. So 50% of the investment was actually returned. So in many of these cases, what is really happening is that if you're going after the bond issuer, the question is solvency, right? Whether they actually do have enough funds to pay out or not. And if they do, then who is the party that you're going after? That also feeds into your chances of success. But of course, if you're going after a foreign government, then really the government is staking its reputation there, right? So part of the reason why we have Drew and Napier, my firm is representing hundreds of these investors, is because we believe that if the Swiss want to save the Swiss reputation for banking, they have to put the 81 bondholders, because they cannot simply upend the traditional hierarchy of losses just so that they sweeten the deal for someone else to swoop in and save Credit Suisse.
Very interesting. And on the corporate front, YT has chimed in. Thank you for your contribution here. You're talking about Chris Energy, shareholder funds, bondholder funds, company now missing in action, MIA. Admittedly, I'm not so familiar with this particular case that I could vouch for the numbers quoted here in the question. But the question still is, Mahesh, what do you do when your emails are not answered and nobody picks up the phone? What recourse, as YT asks, do stakeholders have to redress or address their grievances?
So in Chris Energy's case, after a period of financial troubles, I think last year, COVID, we raised 2 years from our lives. So maybe last year or 2021, I think there was an application for liquidation that was actually filed for Chris Energy. In a liquidation scenario, you then just get a few cents to the dollar at most, right? So you get to prove your debt in the insolvency of that company. That's what happens in the situation like Chris Energy, where there is liquidation. Now, in other situations where you still think that there's money somewhere, then I think most amount a complaint to the MAS, trying to get them to intervene. Where fraud has occurred, nowadays people are savvy enough to call up the police and get the CAD involved, or they simply go to their lawyers and try to seek some form of redress. So I think that's what happens with when your emails stop getting answered and you suddenly get a notice saying that there's an event of default.
Okay, and as Violet asks, what is the role of the underwriting bank and trustee in the case of a bond default?
Underwriting bank, I think other people are more qualified than I am. The trustee really has the right to bring certain action in your name, right? So the trustee who holds on to those rights, it all depends on how the entire investment is actually structured. But generally speaking, the trustee, his job is to secure the trust assets, which is the principal value of the bond, as well as the coupon payouts. So the trustee's job really, if you like, it's almost like an agent, right, on behalf of the investors. I will let the financial people answer what the underwriting bank does.
All right, gentlemen, who wants to pick that one up? Great. Thanks, Benjamin. What is the role of the underwriter?
I was looking at Gerald actually. You know, he's the guy's in that space. So the underwriter, as the name implies, right, underwrites the deal. So what that means is that the company that's doing an IPO will actually sell the entire stake to the bank. The bank underwrites the deal and then securitizes it, you know, splits it out into little bits of one share and then sells it to the public. So that is the role of the underwriter, and the bank makes a spread, because if the bank says, okay, I will pay the company $100 million and then I sell the shares for $110 million, I pocket $10 million. So that is the role of the underwriter. So it's basically, think of it as a distribution channel. Of course, there's the legality of it, wrapping it up and all that, but that's just the distribution channel.
So maybe if I can add to that, I think the other role of the bank in this whole process is also to be able to do some degree of due diligence towards the company. So this will potentially involve, say, ensuring that the company's operations are in order, and be able to provide some level of certainty towards how strong the company's fundamentals are. But that said, there is still a process around working with the lawyers to draft up the documents. And that is what the underwriter would be involved in throughout the entire process, which is why, while the bank or underwriter would have done some degree of due diligence, because at the end of the day, it is still the investor who is putting his money into it, and would have been assumed to have read the necessary T&Cs and documentation and legal documents that come through with the whole transaction. It is important then still for the investor at the end of the day to actually do his own research and educate himself or herself around what are the investment risks and what actually comes through with the investment.
Another legal question for you, Mahesh, from Mr. Lee, who seemingly has studied this issue very closely. Thank you for your research. You've written here, while MAS says it intends to abide by the hierarchy of claims in liquidation, as you've pointed out, Mahesh, it also said that the creditor compensation framework will also apply in the exceptional situation where MAS departs from the creditor hierarchy in order to contain systemic impact. Does this imply MAS may still do what the Swiss did in the Credit Suisse case?
I think that the point really is that the statement that they say that the creditor compensation framework will apply in the exceptional circumstance where they depart from the traditional hierarchy, that followed on from the statement where they said that creditors who receive less from the resolution as compared to what they would have received if the bank had been liquidated, to claim the difference from a resolution fund that will be financed by the financial industry. I'm forgetting the name now. There's a fund that actually compensates them. So I think that's the context in which they actually mentioned that the creditor compensation framework would apply in the exceptional circumstance. But I mean, theoretically, anything is possible, right? But that would mean that in Singapore, they would have to pass an emergency order similar to the FINMA regulator's order that allows you to depart from the hierarchy of losses. But I think in a way, the die is cast, right? For Bank of England, European Central Bank, MAS, they've all come out saying, this is our position as a financial regulator. And if you will, this feeds into the legitimate expectation of bondholders or investors. Investors can, if subsequently they do decide to depart, investors can cite this as an example to say, look, this was what fed into our assessment that anything that's happening in Singapore is safe enough for us to actually participate. So I would be surprised if they do actually depart from the hierarchy.
Okay. 20 minutes, less than 20 minutes to the end of our webinar this evening, our investor forum on Bonds 101. Amy would like to know what your success rate is, Mahesh. What is the chance of suing the issuer and getting your money back?
Suing the issuer and getting your money back, like, I hate to give a lawyer's answer, but the answer is going to be, it depends. is the issuer still good for the money? If the issue in the scenario where the issuer is still good for the money, it depends on whether the default followed the T's and C's or not. And if it didn't, then there is I would say there's a better than even chance for you to get your money back. If what is happening in the world seems to have been provided for in your terms and conditions, then the issuer is simply following that, then there is very little chance of you getting your money back. That's in the scenario where the issuer is still solvent. If the issuer is insolvent, be prepared to get a few cents on the dollar at best. And that's where you probably need to look into whether it's worth it to chase good money after bad, to actually go after someone. But that's where, if the issuer is insolvent, people tend to look elsewhere, right? They either tend to look at whoever it is who sold them the bonds. They also tend to look at, nowadays people are even looking at the auditors of these companies, right? So people tend to get creative, whoever has deeper pockets to seek compensation.
The other lawyer's answer is the lawyer always wins. Okay, a couple more questions about the banking sector in particular. Mr. No writes, in good times, oh, I beg your pardon, Mr. No, I will come back to your question, I promise. Let's go Mr. Lim's question. In a trigger event caused by a liquidity issue, will T2 bank bonds be wiped out as well? They were spared during the Credit Suisse event, even though the same trigger clause was present. Anybody like to tackle that one? Great, Gerald. Benjamin and I are looking at you. What happens in a T2 bank bond? What happens to T2 bank bonds in a liquidity crisis?
To be honest, it's really not a concept that I'm entirely familiar with, so I shall not try to provide any guidance on this.
All right, Benjamin, then Eugene.
It depends on how severe the crisis is, right? Because if if the entire capital structure of the bank is $1 trillion and then depositors are withdrawing substantially the whole amount, then everything is going to be up for grabs. So everybody will be wiped out. So it depends on how bad the crisis is. But bonds are on the hook. I mean, so common shareholders will get wiped out first. Then you got preference shareholders. Then you've got the subordinated bonds, the junior bonds, and all the way to the senior. So it depends on how bad it is.
Eugene, anything else to add?
Yeah, not really my area as well, so that's not going to comment on this.
Okay. All right. Let's then tackle this other one about, James, you wrote, am I correct in understanding that AT1 only applies to bonds issued by banks, but not bonds issued by other corporates? So AT1 bonds issued by banks are regarded as junior bonds issued by the banks. Is that right? Benjamin is still unmuted, so over to you.
So that's my signal. So I should mute myself. So in general, AT1 bonds, additional tier 1 bonds, were accepted by regulators globally under the Basel rules to kind of be a buffer to bulk up the capital requirements for banks. So yes, AT1 bond, that terminology generally just pertains to a bank. So you're not going to have a frozen yogurt company that has got AT1 bonds. So it's generally going to be the regular type bonds.
Okay. Looks like that's about as far as we can go with your question. Mahesh, another question from a potential customer of yours. Jin Zhang writes, so they're not a bondholder, but what are your legal fees to pursue such a case? Thank you. When you say that you're only going to get a few cents in the dollar back, and that's presumably before your fees.
That's in the situation of a liquidation, right? So in a liquidation scenario, people, if they're going after the insolvent bond issuer, they simply need to fill up a proof of debt, right? And the proof of debt is then filed with the liquidator, and the liquidator gets to adjudicate the payouts there. They don't really need a lawyer in that scenario, so they can save the money and proceed against an insolvent issuer themselves. They need a lawyer in the first scenario if they do want to sue the issuer. They need a lawyer in a second scenario if they want to sue third parties, whether it's the regulator, whether it's the government, whether it is the bank that actually sold them that. And usually most disputes lawyers, they charge according to the amount of time they spend on the case. And that's an analysis that a lot of agreed bondholders have to undergo, right? They need to decide whether or not to throw good money after bad, and what's the likelihood of them recovering a certain percentage of their bond value. But that really, of course, again, depends on the case that we're talking about, like the Hyflux bonds or preference shares or the KrisEnergy bonds differ very much from US Treasury bills, differs very much from sovereign bonds issued by the Argentinian government, and also differs very much from AT1 bonds of a bank like Credit Suisse, which I think 3-4 years ago, none of us thought could have ever fallen this far off the mark. So it really depends on the scenario that we're dealing with and the various complexities.
All right, now we're going to wrap in the next 10 minutes with some questions about buying bonds and whether now is actually a good time. So once again, questions for our market specialists. We have 2 questions here asking about whether now is actually still a good time to buy bonds. Thank you, YL, for your question. With interest rates still high, we have one other question here. Thank you. You're asking that as interest rates are expected to stabilize and start tapering down, what investment case is there to buy bonds at this time? Gerald, then Benjamin.
Okay, so I think we would have observed that interest rates have gone up quite significantly, and that will make certain issuances look more attractive than what they were, say, 2 or 3 years ago. But let's also bear in mind that we are in an environment where the economic outlook is still uncertain. And with the economic slowdown, what this means is that some companies may see a fall in demand for their services. On top of that, with higher interest rates, some of these companies could face a higher interest expense as well. So while you might be able to enjoy a higher interest rates for investing in their bonds, we also need to be very conscious of the fact that there might be more companies that might face challenges in either meeting their interest payments if there were to be a further slowdown in the economic growth environment, or if interest rates were to stay high for an extended period of time. Which is why it still goes back to the point around understanding what are the risks and reward of specific investments. Because as what Benjamin shared earlier, there's no free lunch in the market. The reason you're earning a higher interest rate now is potentially with the fact that you might be undertaking a higher risk for certain companies that may not be then eventually be able to repay its debt. So we need to really understand what the company's fundamental and whether or not it is something that we feel comfortable putting our money into.
Benjamin?
Yeah. So just want to point out, just now we had a question about the number of bankruptcies or, bonds going bottoms up. It's been only about 24 in the last 2 decades, and mostly is centered around energy or offshore and marine focused companies. Names like KrisEnergy, Swiber, Rigmus, Maritime, so on and so forth, right? Offshore and energy. So companies in offshore and marine or commodities generally have got a certain cycle, and if it's a Singapore listed company, small medium cap, then obviously is higher risk. So these kind of companies, if you don't want to take the kind of risk, then don't invest in those kind of bonds. Coming back to what Gerald mentioned just now, all things being equal, and this is the key word, so all things being equal, if we are at peak interest rates, and if it comes down starting in November, December, and maybe after Chinese New Year next year, then all things being equal, bond prices should go up, right? So if you can stick to something less risky, and you can hold it till maturity, it's very hard to lose money. I think the problem happens when we need to exit early, or we focus on companies or bonds that give high yields but inherently don't have a very good business model or have a very cyclical kind of models, right?
Okay, Eugene, any views on whether now is still a good time?
Yeah, I think the answer is really nuanced. Do people understand what the kind of risk they're taking? So, for example, even on a basic level, on the Gavi curve, do you want to take duration risk, right? So the maturity is an issue between a 1 month, 3 month, 2 year, 5 year, 10 year. That there's a world of difference, right? And so, how much compensation do you need for each extra risk that you're taking? And then after that, you stack on the credit curve, right? So typically, you would expect that well, the shorter term, you would expect it's easier to repay the debt. But if you stretch out longer, then as a going concern, it could be a problem, right? So then there is also that aspect to consider, right? And then we should look at the outlook. So recession is something that's been thrown around a fair amount, and credit is an additional risk. And it is possible that certain credits are even more creditworthy than, say, the US at this point in time, right? So the question is, what are you holding that investment for? Are you using it to juice returns, or are you using it as a hedge in case things go wrong? And then what is in the price, right? If you're already pricing in a lot of cuts, but the cuts that get delivered are going to be less than what is already priced, you're not going to make money, right? Another thing to consider is that the mark-to-market is a problem for institutions. I'm not sure whether it's going to be the case for retail, but basically, if the bond entity is fine and you can hold it to maturity, it's not an issue. But if you're forced to liquidate and that principal value has fallen a lot, then that's going to be a problem.
Yes, which brings me to our second last question, and that is from Mr. Lim. With technology advancements these days, bank runs can occur at a much faster rate before regulators can react. Look at Signature Bank, right, which we haven't talked about, and Silicon Valley Bank and those others. Are liquidity coverage ratios still a relevant ratio to look at when evaluating bank bonds, Eugene?
I think we got to recognize that the times have changed, right? All those pictures that we see about people queuing out outside branches to take money out, it's not relevant anymore, right? So you whip out your phone and then you can transfer thousands, or if you're really rich, millions at a go, right? So bank runs are much faster now, unfortunately. And then what we have to consider is the other regulations in place to protect us. So, for example, our deposits are guaranteed up to a certain amount. So I think in Singapore it's about 75K. In the US, I think that's higher. So then it becomes an issue is whether it is a moral hazard to just blanket guarantee everything, or should there be some kind of a differentiation? Right. So it's a tough question to answer properly, right? Because I think ideally you want some kind of differentiating factor between banks, because there are still inherent credit risks there. Otherwise, we will just be run by the government.
Okay, last question. Mr. No, I promised you an answer to this one. You're asking, what about popular issuers? Often they're sold out the same day of the launch to accredited investors. Is there actually time to request for a prospectus, have a good read of the prospectus, scrutinize the prospectus when the time frame to sign up is so slim, Gerald?
Okay, so I think as with all investments, what we would recommend investors to do is do not have the fear of missing out. It is better to spend your time to make sure that you have a thorough understanding of your investment, rather than to put your money into something simply because your RM is chasing you for it. Okay, because this investment is something that will probably persist for quite some time. And you just want to make sure that it is something that you are able to get the expected return by putting your money in. And maybe just to add a bit more around what has been asked earlier on the bank ratios, I think what we would also advocate is that when you have the time, do not just look at one financial ratio. So as you want to be diversifying your portfolio, when you're trying to understand a particular issuance, it is important to look at different financial ratios to have a holistic view of the company. So in the same way that when we are looking at a stock investment, it's not just about the income statement. We look at the balance sheet as well. When analyzing bond investments, we should not just be looking at one single ratio.
Okay, and you also mentioned a website earlier on, which you are not affiliated with, for places to go for information and possibly to buy
That's
bonds.
right.
Would you like to repeat what website that was?
So I guess in Singapore, you've got different financial platforms. Within the bond market, there would be Bond Supermart that some of you might be familiar with. I guess apart from that, you might be able to find some information on our platform, growbeansprout.com as well. But I think with the proliferation of digital platforms, information on the internet, even some of the sites like Yahoo Finance, you'll be able to find good numbers that are reliable around different issuances or companies that you might be looking at.
Right. Well, that brings us to the end of our investor forum. As you exit our webinar, please be sure to complete the feedback form. The details will pop up on your screen once you exit. And there's also the opportunity for you to leave us a Google review. We hope you enjoyed our session this evening. My thanks to Gerald, Benjamin, Eugene, and Mahesh. Thank you for your company, and see you in the next Investor Forum by SIAS. Good night.